Hello, and welcome to 3C Money Matters, a podcast for clients, colleagues, and community. I'm Alice Zalman with the 3C Group of Baird, and joining me again today as my team host is my colleague, Dan Matthews. Dan, how are you this afternoon?
I am fantastic and improving.
That's good. That's the way you want to be. Well, appreciate you being here alongside me as always. If you've listened to our show before, you know that our goal is to help inform, maybe entertain a bit, but provide content that backs up our team's mission to be a great teammate for clients, colleagues, and community. And with that, we are so fortunate to have our guest for today's episode, Tim Steffen, who is the Director of Advanced Planning for Baird. In that role, Tim helps our clients understand and navigate both simple and complex planning topics, understand the impact of legislation, estate planning, tax planning laws, and changes. So with that, Tim, we are so fortunate to have you today. Thanks for joining us.
Thanks for having me. Looking forward to this.
Are you joining us from Milwaukee? Whereabouts are you?
I am in our corporate office in downtown Milwaukee overlooking the beautiful Lake Michigan and enjoying the remaining days of summer, or I guess early fall now down here.
Wonderful. Well, thank you so much again for joining us. In addition to the great help that Tim provides our clients and us as advisors and teams, you can also find his commentary on national and regional media publications, including the Wall Street Journal, CNBC. So we're very fortunate to have him. He'll be talking with us today to help us understand the impact of legislation that was recently passed this summer, known as the One Big Beautiful Bill Act, or the OBBBA. It's a long name and also a long bill. I think it's over 1,000 pages, the actual legislation. So we obviously won't be able to cover everything, but Tim's here to help us understand the most important and impactful points for our clients to consider as part of that legislation from a planning perspective. However, before we dig into the legislation, if you've listened to our show before, you know the first question we ask every guest to help get to know them a bit, hopefully have a little fun along the way, is what is their favorite movie and why? Then, as part of that, Dan and I's challenge as team hosts is to try to work quotes or concepts from that particular movie naturally into the episode. So, Tim, please tell us, what is your favorite movie and why?
Well, it's always a challenge to narrow that down to one, but I figured I'd give you guys a little bit of a challenge, and I decided to go with a holiday movie. So we're going to go with It's a Wonderful Life. Great holiday movie. I remember first seeing it when I was in probably junior high or something like that, and just loved the movie, loved the message it sends about that every life has an impact, and every little bit of what you do is planned out, and the impact you have on people is more than you possibly realize. So I just think it's a great, positive movie.
Totally agree. And actually, it's not a challenge for me. I don't feel like I've seen it so many times. I personally grew up in a small town in southern Indiana, Bedford, Indiana, which in my mind as a kid was a great proxy for Bedford Falls. It actually has, as well, in my mind, one of the best movie lines ever about money. Obviously, an important topic to us, which is in the scene just after Clarence has rescued George Bailey from the bridge. They're talking, and George says something along the lines of, well, do you have $8,000 I could borrow? Because I kind of need it. To which Clarence says, well, we don't use money in heaven. And then George says, yeah, I keep forgetting about that, but comes in pretty handy down here, Bob. So it always made me laugh. In any case, let's jump to the legislation and impacts there. Tim, from your perspective and your expertise, what are the major high-level points or changes from this legislation that will be most impactful to people, particularly the types of clients that we tend to work for at Baird?
Sure. Yeah. The most impactful thing is probably not anything that's gotten the most attention, but it's really going to literally impact every taxpayer out there. And that is an extension of a set of rules that were set to expire at the end of 2025. So we go back to 2017, there was a bill that was passed called the Tax Cuts and Jobs Act. Many very impactful changes that changed the way our tax system works. And we've been dealing with those for the last 7 or 8 years now. Many of those changes were set to go away. And while there's like any bill, there's some good and some bad and some positive, some negatives in there. Overall, had those changes gone away, it would have been a net negative for a lot of people. Higher tax rates, lower deductions, AMT comes roaring back, state tax comes back. Fortunately, we were able to kind of dodge all of that with this bill. This bill effectively extended all of those things that were originally set to expire this year, extended them indefinitely, which is kind of a weird term to use when it comes to tax law, because there is no such thing as a permanent tax law. We always say that. So while these are permanent changes, they're only permanent until somebody decides to change it again. But we know we're in this state of certainty, at least for our tax code, as good as it gets. So keep our lower tax rates, keep our higher standard deduction, our higher estate tax exemption. All those things are staying in place. People don't talk much about it, but those are really important things that happen. So that's where we start. Beyond that, we got a whole litany of things we can talk about that are kind of interesting and a few impactful things. A lot of these are kind of narrowly focused for specific individuals, but some of these are more broad-based, and we can get into more of those here as well.
Go ahead, Tim. I'm sorry.
Sure, yeah. So probably the two that we get asked the most about, this thing called the SALT limit. SALT is an acronym, state and local taxes. Part of the original bill from years ago put an artificial or a new cap on that. So the most you could deduct of your state and local income taxes and your property taxes was $10,000. It used to be you could deduct all of it. Now you've only for the last several years been able to deduct $10,000. Beginning this year now, they've changed that to increase the ceiling up to $40,000. Still a cap, but for a lot of people, that's going to be enough to make all those taxes that they hadn't been deducting now fully deductible. One thing to keep in mind on that, and this is kind of a recurring theme throughout this bill that we have to be aware of, is this idea of phase outs. This increase in the SALT deduction goes away for people with income over a certain threshold. The general rule is if you're a single taxpayer, a married couple with income below $500,000, you can have that full $40,000 SALT deduction. As your income crosses that and goes up to $600,000, that increase goes away, phases out to where it goes from $40,000 down to $10,000. Once you're past $600,000 of income, that $10,000 stays in place. That's your floor then. That's permanent. So you've got this kind of range of income. You got to be really careful about what happens. And we can talk more about that in a little bit if you'd like. But this SALT deduction, that's the one that's probably most universal impact. Another one that's big out there is this new deduction for seniors. It's a separate $6,000 deduction for anybody age 65. There's, again, some nuances with that, phase outs with that, et cetera. But those two are probably the ones we're getting the most questions about. Lots of other little ones that are very targeted we can talk about, but those are the two I think are the most impactful in terms of the new items in the bill.
Tim, to clarify in particular on the over 65 deduction, you mentioned $6,000 per person. There are income thresholds to be aware of, though. But again, if you're looking at a married couple, that's $6,000 per person. Is that correct? So $12,000 for a married couple.
That is correct. So if you've got a married couple and one is over 65 and one is not, you get a $6,000 deduction. If you're both over 65, you get two of those $6,000 deductions. Correct. And, there is a phase out on that. It's a little lower level phase out. For this one, it phases out for married couples beginning at $150,000 of income and fully phases out at $250,000 of income. So you've got this window between $150,000 and $250,000 where couples can lose that deduction. Singles, it's going to be half that. So between $75,000 and $175,000 is going to be the range for them.
And again, one more point of clarification, and my apologies if you did mention this, but I know this is going to potentially impact quite a few people and certainly our clients. But that is not a permanent provision, correct? That is meant to last, I believe, until 2028?
Through 2020, yeah. So a lot of these new items have short time periods on them too. 2025 through 2028 for this one and a couple of the others. The SALT one we talked a little bit before earlier, that also is 2025 through 2029. So you get one extra year on the SALT one, but this new senior deduction, 25 through 28. Just to give a little background on that one, this is the one when they talked during the campaign about making Social Security benefits tax-free. You can't really do that in tax law. There's a whole separate set of rules that go with that. So this is their attempt to make Social Security benefits tax-free. As it turns out, it's got absolutely nothing to do with Social Security. You don't have to be on Social Security to get this. If you're on Social Security, it's still going to be taxed like it always was, but it's just a new deduction for people who are likely going to be on Social Security. That's maybe the connection. So don't mix the two up. They are two different things now.
Okay.
So would you say, can I ask one question here? This is actually related to Mr. Potter, who, let's assume he is in the highest income bracket and a senior. If he is both of those things, which I would assume based on the movie that he was, there's not a lot of benefit towards him because of the income thresholds on the SALT deduction and the senior deduction. Is that correct?
Yeah, if this were in today's dollars and he were in our top tax bracket, pretty much all these new things we'd be talking about, he wouldn't be eligible for. Now, I suspect Mr. Potter had some under-the-table income that he wasn't reporting, so maybe that's how he got away with it, but we'll assume he was on the up and up on those.
Okay.
By the way, I think an interesting point about Mr. Potter, the actor who played him, Lionel Barrymore, is the great uncle of Drew Barrymore, who most of us know as an actress. So great question, Dan.
Thank you.
Tim, certainly you mentioned two high-level points that will be impactful for people. I know there are also, in previous presentations, you've given some other kind of deduction-related considerations that from a planning perspective, particularly as we start to approach the end of the year, that you thought are important for people to know, particularly as it relates to potential charitable giving, particularly if you've got appreciated stock. So imagine a scenario where somebody has, we'll use Eli Lilly as an example, Eli Lilly stock that's gone up significantly in value, and therefore that person has a significant amount of unrealized capital gains. There are some deduction considerations as it relates to income that are a bit of a change. Can you explain that for us?
Yeah. So just to be clear, nothing has changed in the rules about donating appreciated stock specifically. You can still donate appreciated stock. The gain effectively goes away when you donate that stock. You get a deduction for the fair market value, and you don't have to pay tax on the gain. That rule is still in place. There are more broad changes to deductions overall and somewhat charitable specifically that would maybe reduce the value of that gift a little bit. But so let's talk about each of those. The first one is there is a new ceiling on the value of all itemized deductions. So today, you're a top bracket taxpayer in the 37% bracket. You give $1,000 to charity. You pay $1,000 in mortgage interest, pay $1,000 in property taxes. That $1,000 deduction, because you're in the 37% bracket, saves you $370. Beginning in 2026, the value of deductions for people in the top bracket will be capped. So if you're a 37% bracket taxpayer and you give that same $1,000 to charity next year, your deduction will be limited to 35% or $350. So you lose $20 worth of the value of that deduction. Now, in this example we're giving, is that a huge adjustment? Probably not. It's not a thing that's going to have a material effect on most people, but it does slightly reduce the value of your deductions for people only in the top bracket beginning next year, 2026. So that applies to all deductions, including charitable gifts, but everything else. The other one is specific to charity, and this is a new floor on the value of your deduction. So I kind of think most people are familiar with the idea with medical expenses. You can only deduct your medical expenses if they exceed a certain percentage of your income. For medical, it's 7.5%. Well, now they've done a similar thing on the charitable side. With charitable gifts, you can only deduct charitable gifts that exceed 0.5% of your income. That's our 0.5, so it's a very low level. Just to put that in perspective, if you are somebody with $100,000 of income, your first $500 of charitable gifts provide you no tax deduction. Okay, so as your income goes higher, obviously that floor gets bigger, but next year, the first few dollars at least of your charitable gifts won't provide you any tax benefit. That's a 2026 thing as well. So when we look at those two things combined, a ceiling on the value of deductions for people in the top bracket, and a floor on the value of charitable gifts specifically for all taxpayers, there's an argument to be made that charitable gifts might be more valuable if they're made in 2025 versus in 2026. You don't have the ceiling, you don't have the floor, you get the full value of the deduction. There's a lot of other things that go into when you might want to make a charitable gift, but all things being equal between this year and next, your gifts will be a little bit more valuable in 2025. So that's one of the things we're talking to people. Those who do a lot of charitable giving and are affected by those changes might want to think about accelerating their gifts into this calendar year.
Yep. And obviously, the majority of our clients don't give to charity just because of the tax benefits, but it's certainly something to be mindful of as we go along. Tim, any other kind of new items, changes from this bill along those lines that are important to you for people to know about and consider?
So we about some of those more unique deductions that are out there. We've got this a lot of these were things that came up during the campaign from last fall. This new deduction for people who have tip income, a new deduction for people who get paid overtime income, not just, it's the extra income you get. If you get paid time and a half overtime, that extra half, you might be able to take a deduction for some of that. If you're purchasing a car that was assembled here in the U.S. and you use and you finance that, some of the interest you pay on that loan may be tax deductible beginning in this year, 2025. All three of those are new beginning this year and run through 2028. Like we've talked before, they all have caps on the amount of the deduction, and they're all subject to those phase outs. So as people's income gets bigger, they begin to lose the value of some of those deductions. So we can talk about the importance of tax planning in a bit, but this is some of these new things to be aware of that you want to kind of plan around if you think you might be eligible for them. Other things that are out there from an estate standpoint, the estate tax is something hardly anybody pays. It was going to hit maybe a lot more people next year if some of the changes we had anticipated happening might have happened. Turns out none of those are going to happen. In fact, there'll be even fewer people subject to the estate tax next year than what we had thought because they increased the exemption. Without getting too far into the weeds, today your first $14 million you pass to somebody at death is exempt from tax. Therefore, most people don't pay estate tax. That number might have fallen a lot next year. In fact, it ended up going up instead. So some good things from an estate tax planning standpoint taking effect next year. A lot of other things, if you're a business owner, some important changes there to be concerned about, especially if you're starting a new business. Really be careful about how you choose to form that business. Tax breaks available for different types of entity choices. So be very thoughtful about what you do there. From a retirement standpoint, not a whole lot really changed, quite honestly. All the rules are in place for what you can put in, when you have to take out money from retirement accounts, all the rules in those. Not a lot real change there at all. So that's kind of stayed status quo. So that's good.
You mentioned estate planning. Many of our clients and families that we work with are concerned, obviously, about making sure that they have what they need to be taken care of for their lifetimes, but also focused on planning for their children, grandchildren, the next generation. There were some points, some new account types to consider saving for kids or grandkids that came out of this legislation. Could you touch on some of those points?
Yeah, so there is the one thing that's sort of ancillary to retirement planning is this new savings account that was created. So it's being called the Trump account. And what it is, it's an account that can be set up for minors. You have to be under age 18 to even own one of these to begin with. So for anybody who's under age 18, there's a new vehicle in which you can put money into the account, non-deductible going in, so there's no tax break for putting it in there. But while it's in there, it grows on a tax-deferred basis. We're kind of treating this like it's almost like an IRA. And in fact, once a child turns 18, it kind of becomes an IRA under the tax law. I don't know if it actually becomes an IRA, but it mimics one. It's all the same rules on putting money in and taking money out and requiring distributions and all that. But this is an account specifically for people under the age of 18. A couple of unique things with it is that once for any children who are born in 2025 through 2028, you can request an actual $1,000 contribution from the government. So you can get it seeded with government money into that account, which is kind of a nice starting point. Money that's in there gets grows on a tax deferred basis and literally can't be taken out until you're 18. Very, very few exceptions on how to access that money. It's meant to be a long-term investment. As part of that, these accounts have very specific investment restrictions. It's meant to be long-term money. Therefore, the money has to be invested in U.S. equity index type funds, ETFs, those kind of things. So very specific investments. Not that you have to go into a particular fund, but the broad category has to be low-cost U.S. equity index type funds. Wait for more nuances and more details from the government on how that's going to be applied, but that's the general purpose of these. These are meant to be starter accounts for minors to provide them a starting point for saving some money so that when they get later into life, they've got a nice pool of money started to be built for them. They become kind of another arrow in your quiver when you're thinking about how you're going to save if you've got money you're going to give to a minor. We're all familiar with UTMA accounts, been around forever. 529 is a great way to save for college. If your minor has a job, they're working somewhere, you can put money into an IRA for them. And now we've got this fourth account, this Trump account, that kind of a little bit of each of those. Each of those have their own advantages and disadvantages. Just have another option as you're thinking about how you might give money to a minor next year. And again, we can't do this till 2026. Important point there. But as you're thinking about it, something new to consider for your gifting dollars next year.
One question about that, have they said anything about whether you could because it did not exist before, transfer money from a UTMA account into a Trump account? Is that mentioned in any way?
So remember, UTMA is the child's money already. So if it makes, they can put up to $5,000 into the Trump account. So yeah, you could theoretically take $5,000 out of the UTMA account and put it into the Trump account, as long as the child's still under 18, which they would be anyways if they still got an UTMA. So yes, theoretically, if you want to get some of the tax advantages of the Trump account while also being willing to accept some of the limitations that come with it, because again, once you turn 18, you can get at it, but it's taxable and penalized if you do so. So you got to be careful with that. UTMA creates a lot more flexibility. You can kind of get at it for whatever you want once the child hits a certain age. That can be good. That can be bad. Putting in the Trump account, some tax advantages, but some handcuffs on you as well.
Well, Tim, thank you again so much for these wonderful insights. As I mentioned, and it's hard to believe, we are approaching the end of the year. So our hope is that you'll be willing to join us again as a guest for a future episode coming up before year end, where we can focus more specifically on some of the planning considerations and opportunities that may come out of this to optimize financial planning, tax planning, estate planning, and so forth. Outside of that, any other information questions you'd like to pass along from our discussion today?
Just, the importance of planning on some of this stuff. The one thing we've learned in these new rules is that back of the envelope tax planning is really hard to do. It used to be you could just say, hey, I'm in the 22% bracket. Therefore, my income, if I do a Roth conversion, for example, is going to be taxed at 22%. It's not that easy to figure that out anymore because there's all these new phase outs and exemptions and things you got to be aware of. So back of the envelope tax planning is always a little hard to do. Now it's really hard to do. Best to work with somebody who really understands this stuff and has access to great tools. Fortunately, that describes your team. You've got the resources you need to really help with some of this more complicated planning. So looking forward to helping out our clients with all these things.
Wonderful, Tim. Well, we are so grateful again that you were willing to join us. We appreciate your expertise. You mentioned It's a Wonderful Life. And as we close the episode, makes me think a lot. Obviously, what we tried to do here at Baird is help our clients understand their money and keep their money, make more money. But if we think about the lessons from It's a Wonderful Life, I'm reminded of the last scene, the final scene of the film. Clarence has left behind his copy of the book, Tom Sawyer. And as George Bailey is standing with his family, the townspeople are coming over to help out George, the Bailey Brothers Building and Loan. Clarence has left an inscription in the book for George that says, "Remember, no man is a failure who has friends." And I think, although we're very focused in our day-to-day jobs, helping clients with their money, I think if any of us are fortunate enough to enjoy good friends and the love of family, then may we all be George Bailey at the end of the movie when his brother Harry toasts him and says, "To my big brother George, the richest man in town." So with that, thank you, Tim. Thank you to our listeners for joining us for 3C Money Matters. We'll catch you next time.
This broadcast contains the current opinions of the host and are subject to change. The broadcast is provided for informational purposes only, is not a complete analysis of every material fact regarding any company, industry, or security, and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Robert W. Baird & Company Incorporated, member SIPC.